It's the speed that bothers me. You don't lose $41 in 48 hours on natural selling. That's not how liquidation works when it's organic, when it's just people taking profits or changing their minds about the macro picture. That kind of movement, that's structural. It feels engineered. And I know the moment you say engineered, half the room rolls their eyes and the other half puts on a tinfoil hat. But look at the tape. Just look at the candles on the hourly from Tuesday morning. We hit 121 in January, touched it really, and everyone felt like the ceiling had finally blown off. The thesis was perfect. The industrial demand was there. The vaults were draining. And for a minute, it looked like price discovery was finally acting rational. Then, in 2 days, we are back at 80, a 33% haircut, just like that. And the narrative shifted instantly. You saw it. The headlines flipped from silver shortage to speculative bubble before the close of trading on the first down day. Treasury Secretary Bessent comes out and calls it a speculative blowoff. He used those exact words, said the market got ahead of itself and needed to cool down. And on the surface, sure, a $40 drop validates that statement. It looks like he was right. It looks like the retail crowd got excited, chased a ghost, and got punished for it. That is the story they are selling you right now. You got greedy and the market humbled you. But that story doesn't account for what happened in the futures market about 4 hours before the selling started. It doesn't explain the open interest anomaly I saw in the COMEX Tuesday morning. See, normally when a price crashes like this, you expect open interest to collapse with it. Longs get liquidated, positions get closed, the market flushes out. The price goes down, participation goes down. That is a healthy, painful correction. It's a reset. But that is not what happened here. Not entirely. I've been staring at the exchange for distinct reports for the last 6 hours, trying to reconcile the volume with the price action, and there's a disconnect that makes me incredibly uncomfortable. If this was just a blow-off top, if this was just retail panic, the internals of the market would look very different. Instead, we're seeing something that looks less like a chaotic exit and more like a very specific, very controlled transfer of liability. Most people are looking at the $80 price tag and asking if they should sell before it goes to $60. They're asking the wrong question. The question isn't where the price is today. The question is, who was sitting on the bid side absorbing that volume while the price was free-falling? Because someone was. The volume profile shows massive absorption at levels that shouldn't have held if this was pure panic. There is a trap here. I'm just trying to figure out if the trap was set at 121 to catch the bulls, or if the trap is being set right now, at 80, to shake them out before the real move happens. Because there is one specific data point from the vaults, not the price, the actual physical inventory that contradicts everything the Treasury just said. And if that number is right, then this crash wasn't a blow-off. It was a clearance sale for someone who knew exactly when to pull the rug. Let's walk through the anatomy of this thing, because if you're holding silver, or if you just sold it in a panic, you need to see what happened in the dark pools while everyone was staring at the red candles. Let's be real about the damage first, because I see the comments and I know a lot of you are hurting. If you came in late, if you bought in at 115, 118, or God forbid, right at the peak of 121, this isn't just a correction to you. This is a disaster. You're looking at a portfolio that is down 30, 40% in 2 days. And that physical sickening feeling in your stomach, that is exactly what this move was designed to create. It's important to understand who actually gets killed in a move like this. The guy stacking coins in his basement since 2015, he's annoyed. He watched his net worth spike and then retrace, but he's still up massive from where he started. He's not the target. The target is the leveraged retail trader and the late-stage momentum buyer, the people who saw the headlines, saw the silver to $200 tweets, and piled in with margin. When the price drops $41 in 48 hours, those people don't just lose money. They get liquidated. They get forced out. And that forced selling is what creates the velocity. That's why we see vertical red lines on the chart. It's a cascade. One margin call triggers selling, which drops the price, which triggers the next margin call below it. It's mechanical. It's automatic. But here's where the narrative starts to fracture. When Treasury Secretary Bessent stood up and called this a speculative blow-off, he was giving you the comfortable textbook explanation. It's a clean story. He's saying, look, the price went up too fast, it got detached from reality, and now gravity is taking over. It frames the government and the regulators as the adults in the room, watching the children play with fire and get burned. It suggests that the price of 121 was fake, and the price of 80 is real. I have a hard time accepting that. And I'm not saying that because I'm a silver bull or because I want the price to be high. I'm saying it because of the open interest data on the COMEX. For those of you who don't stare at these reports all day, let me explain open interest in the simplest way possible. It is the total number of active contracts sitting on the board. It's the number of bets currently in play. Now, in a normal, healthy liquidation, a real blow-off top where buyers are just exhausted and giving up, you expect to see open interest drop significantly. Why? Because the longs are selling to close their positions. They are leaving the casino. They take their loss, they sell their contract, the contract disappears, and the open interest number goes down. Price down, participation down. That is a market acknowledging it was wrong. But look at Tuesday. We had a violent crash in price. We dropped nearly $20 in a single session. And yet, the open interest didn't collapse the way it should have. It stayed stubbornly high. In some hourly blocks, it actually ticked up. This is the part where it stops making sense if you believe the official story. If retail is panicking and selling, and the price is crashing, but the number of contracts is staying the same, that means for every panicked retail trader selling a long contract at a loss, someone else is stepping in and opening a new position. Who steps in front of a falling knife? Who buys when the chart looks like a waterfall? It's not you. It's not me. It's certainly not the retail guy who just got a margin call. It's the commercials. It's the bullion banks. It's the swap dealers. This is the anomaly that tells me this wasn't just a blow-off. This was a transfer of ownership. We just witnessed one of the largest transfers of paper silver from weak hands to strong hands in the last decade. The retail crowd was forced to sell at the bottom of the range, and the institutional desks were there to absorb that liquidity. Think about the incentives here. If you are a bullion bank and you know there's a physical shortage coming, and we'll get to the physical data in a minute because that is the elephant in the room, but if you know the supply is tight, you cannot buy when the price is ripping to 121. You can't chase it. You need liquidity to build a position. And nothing creates liquidity like panic. So when Bessent calls it a speculative blow-off, he's technically right, but not in the way he means. The speculation was retail chasing the price. The blow-off was the institutions using that leverage to flush the market. They cleared the decks. They took out the stops. They reset the RSI. And now they are holding the contracts at $80 that retail was fighting to buy at $120. I want you to look at the volume profile from Wednesday morning specifically. Usually on a crash, you see heavy volume at the top as people rush for the exit, and then it thins out as the price falls. But Wednesday showed massive volume clusters right at the lows, around the $82 and $80 marks. That is absorption. That is a limit order book that was stacked with buy orders waiting for the price to get there. You don't stack buy orders at $80 if you think the asset is worthless. You don't catch a falling knife with that much capital unless you know exactly where the floor is. And this brings me to the contradiction that is driving me crazy. We are being told that silver crashed because nobody wanted it at 121. We are being told demand evaporated. Yet at the exact same time price was collapsing on the COMEX, the premiums on physical coins and bars at the major dealers did not budge. Actually, that's not true. They went up. I checked 3 major dealer spreads this morning. While spot price was down 30%, the premium over spot for physical delivery increased. If this was a true bear market move, if nobody wanted silver, dealers would be slashing premiums to move inventory. They aren't. They are widening the spreads. They're saying, sure, the paper price is down, but if you want the actual metal, it's going to cost you. That disconnect between the paper price crashing and the physical price hardening is the signal. It's the smoke alarm. Most people look at the chart and see a red line and think loss. I look at that chart combined with the open interest and the physical premiums, and I see a lockout. They're locking the door. They knock the price down to a level where the chart looks broken, which scares away the new investors. They flushed out the leverage, which removes the volatility for a moment. And now they can accumulate quietly while the media runs headlines about how the silver bubble burst. But here's the thing that really keeps me up at night regarding this specific drop. It's the timing relative to the Shanghai Gold Exchange. I watch the arbitrage between East and West. Usually COMEX leads, but this time the selling started in the West while the East was sleeping. By the time Shanghai opened, the price had already been smashed. The East didn't sell. The East woke up to a discount. If this was a global reassessment of silver's value, Shanghai would have participated in the sell-off. They didn't drive it. This was a Western-led, derivatives-driven liquidation event. It was localized to the markets where paper leverage is the highest. So we have a crash that 1. Didn't reduce open interest the way it should have, 2. Was absorbed by massive limit orders at the lows, 3. Disconnected from physical premiums, 4. Originated entirely in the paper markets of the West. Does that sound like a bubble popping naturally to you? Or does it sound like a changing of the guard? The danger here, and the reason I'm recording this right now instead of waiting for the weekly close, is that most retail investors are going to look at their account balance, feel the pain, and walk away. They are going to sell the bottom because the fear is unbearable. They're going to say, Bessent was right, it was a scam, I'm out. And that is exactly what the smart money is counting on. They need you to capitulate. They need your inventory. Because, and this is the part we are going to get into next, the supply numbers for the next quarter are looking absolutely terrified. I'm looking at the industrial delivery schedules for Q2 and Q3, specifically for the solar and EV sectors, and the math simply doesn't work at $80. It didn't really work at $120, but at $80, it's a joke. We are staring at a structural deficit that hasn't changed just because some hedge funds decided to paint the tape red for 48 hours. Actually, the deficit just got worse because at $80, mine supply gets squeezed even harder. But before we talk about the shortage, we have to talk about the mechanism of the trap itself. Because if you don't understand how they use the blow-off narrative to hide the liquidity crisis, you're going to get caught in the next flush too. What we have to look at here is the repo market and the lease rates. That's where the real smoking gun is. It's boring, it's technical, and it's the only thing that matters right now. The thing about market mechanics is that they aren't nearly as loud as the price. Price screams. It's on every news ticker, it's the red number on your phone. But lease rates? They whisper. And right now, those whispers are sounding like a siren. To understand why silver just did what it did, you have to look at the cost of borrowing the metal. Most people think silver just sits in a vault. But in the institutional world, silver is a currency. It gets leased out. It gets moved around to cover short-term obligations. Normally, silver lease rates are negligible, maybe 1 or 2%. It's a sleepy corner of the market. But while the price was crashing from 100 to 80, the lease rate started spiking. They didn't go down with the price, they went up. It actually became more expensive to get your hands on physical silver for a week than it was when the price was $40 higher. Think about how backward that is. If the market is supposedly in a speculative blow-off and everyone is dumping their silver, the lease rates should be zero. There should be silver everywhere. The market should be awash in supply. Instead, the cost to borrow suggests that the physical market is now tighter at $80 than it was at the peak. This is the mechanism I wanted to explain. It's called a liquidity squeeze. What we likely saw was a massive player, possibly a sovereign entity or a major industrial consumer, demanding physical delivery on a scale that COMEX wasn't prepared for. When that happens, the bullion banks have a problem. They're short the metal on paper, and they don't have the bars in the vault to satisfy the delivery. If they let the price keep running to 150 or 200, the cost to settle those deliveries would bankrupt them. So they do the only thing they can. They break the price. They use their massive paper leverage to flood the futures market with sell orders, triggering those retail stops we talked about and driving the price down to a level where they can settle their obligations or convince the delivery seekers to take a cash settlement instead of the metal. It's a strategic default in everything but name. But I want to be fair here. I have to look at the other side.
Because if I'm wrong, and this actually is the beginning of a long-term bear market, there's a very specific way that would play out. What would invalidate this entire thesis? If I'm wrong, here's what you'll see. Over the next 2 weeks, you'll see the lease rates collapse back to zero. You'll see the physical premiums at dealers start to vanish. And most importantly, you'll see the COMEX vault inventory start to rise. If people are truly dumping silver, it has to end up in the vaults. If the vaults start filling up while the price is dropping, then Bessent was right. Then it really was just a bubble and we're going back to $30. That's the kill switch for my argument. I'm watching those vault numbers every day at 4 p.m. If they tick up, I'm changing my mind. But so far, they are still ticking down. Even during the crash, the metal is leaving the registered accounts. You have to distinguish between market sentiment and structural reality. Market sentiment is what you see on Twitter. It's the silver is dead posts. Structural reality is the fact that a silver mine takes 10 years to come online, and the solar industry is currently consuming 20% of the global annual supply, irregardless of what the COMEX price says. The industry doesn't care about the rug pull. A solar panel manufacturer in Shanghai doesn't look at a $40 drop and say, "Oh, I guess we'll stop making panels." They look at that drop and say, "Oh, silver is on sale, let's buy the next 6 months of inventory right now."
That's the structural signal people are missing. The lower the price goes, the faster the physical supply disappears. The paper market is currently fighting a war against the physical reality, and the paper market is winning the battle of the price, but it's losing the war of the inventory. It sets up a binary path forward. There is no middle ground after a move this violent. Path A is the broken chart scenario. The price stays under $90 for a month, the technical damage becomes permanent, and the silver story dies for another 5 years. That's the path where the institutions successfully scared everyone away, and the industrial users found a way to substitute the metal, which, by the way, they haven't been able to do for 50 years. Path B is the springboard scenario. This crash was the clear the decks move. It removed the dead wood, the leveraged traders who would have sold at 130 anyway, and transferred their contracts to the very banks that were previously short. In this scenario, the price doesn't just recover, it launches, because now the people who were suppressing the price are the ones who are long. This is where the game gets very dark, because if the banks are now long at 80, they have every incentive to let the price go to 300. They've already bought the retail capitulation. They've already filled their bangs at the discount. The next 48 hours are going to tell us which path we're on, not based on the headlines, but based on whether the $80 support holds as a floor or becomes a ceiling. I want to move into the actual playbook now, because knowing all of this is useless if you don't know how to position yourself for the climax of this move. We're reaching the end of the paper era of this market, and the resolution is going to be faster than most people can react to. We are entering the climax of this cycle. When you see a $40 move in 2 days, the quiet part of the investment is over. From here on out, it's going to be high volatility, high stress, and high stakes. Here is how the scenario tree looks from my desk. If we see silver reclaim $95 by the end of this week, the trap is confirmed. Reclaiming that level would mean the liquidity flush did its job and the buyers have regained control. If that happens, the consequence is a short squeeze that will make January look like a warm-up. You'll have the banks who stayed short scrambling to cover, and you'll have the retail crowd that just sold at 80 trying to chase it back up in a panic. That's how you get to $200 very quickly. If we stay below $80 and start guessing 72, then we're in a different regime. That's the consequence of a broader macro breakdown. That's silver telling us that the global economy is slowing down so fast that even the industrial demand can't save it. In that scenario, cash is king, and you wait for the dust to settle. I'm watching the gold-silver ratio specifically. During this crash, the ratio spiked back up. Silver underperformed gold significantly. In a true bull market, silver should be leading. The fact that it lagged and got crushed tells me the paper shorts specifically targeted silver because it's a smaller, more volatile market.
They knew they could break the silver chart easier than they could break gold. So here is my playbook. Here is exactly what I am doing, and more importantly, what I am not doing. First, I am explicitly not selling. I know that sounds like diamond hands nonsense, but I look at my cost basis and I look at the physical supply, and I realize that if I sell now, I'm simply handing my position to the person who engineered the drop. It refuses to be the liquidity for a bullion bank. Second, I'm watching the deliveries versus the cash settlements. There are rumors, unconfirmed but persistent, that several large entities were offered a 50% premium over spot to settle their contracts in cash rather than taking the metal. If those rumors are true, it means the real price of silver isn't 80, it isn't even 120, it's whatever the hush money settlement price is. I'm looking for any filing or any whistleblower that confirms the COMEX is struggling to settle.
Third, what would change my stance? I told you earlier, the vault numbers. But there's one more thing. If Treasury Sec Bessent announces new emergency margin requirements for silver specifically, that is a sign that the government is stepping in to protect the shorts. If they change the rules of the game mid-match, then the free market thesis is dead, and I have to reevaluate whether this asset can ever be allowed to reach its true value in a Western exchange. This isn't a game for the faint of heart anymore. We are watching a systemic tug of war. On one side, you have the physical reality of a world that needs silver for energy, for electronics, and for a hedge against a debasing dollar. On the other side, you have a financial system that cannot afford a run on the precious metals because it exposes the insolvency of the paper currency. The crash to 80 was a massive, violent shove from the financial system. They are trying to push the crowd away from the exit. But you have to ask yourself, if silver was truly a failed speculative bubble, why are they working so hard to tell you it's over? Why does the Treasury Secretary feel the need to comment on a mid-cap metal market? They don't talk about things that don't matter. I want to leave you with a question, and I want you to be honest with yourself, setting aside the pain of the last 48 hours. Do you believe that in the next 5 years, the world will need more silver than it does today, or less? If your answer is more, then the price on the screen is just noise. It's a temporary psychological hurdle. If your answer is less, then you should have sold at 121 and never looked back. I'm not interested in the hype. I'm interested in the math. And the math says that $80 silver in a world of infinite currency printing and shrinking mine supply is an anomaly that cannot last. I'm going to be watching the commercial signal report coming out this Friday. There is a specific document, the bank participation report, that is going to show us exactly how many big 4 inches banks flipped from short to long during this crash. If that document shows what I think it shows, the trap will be proven beyond the shadow of a doubt. I'll be digging into that the moment it hits the tape. Until then, stay grounded. Don't let a red candle make your decisions for you. Watch the vaults, watch the lease rates, and remember that the most violent moves always happen right before the trend changes for good. The decks are being cleared. The only question is whether you'll be on the ship when it leaves the dock.